Hello and welcome to a brand new show of Market Makers. How should one read into the current global financial mayhem? It's a very simple question, it's a very straightforward question, and that is the question we wish to answer on this edition of Market Makers with a very special guest and market veteran, Prashant Jain of HDFC AMC. Prashant, so nice to have you back and thank you for joining us.
Pleasure.
How should one read into the current market mayhem?
I think, history tells us that whenever Indian markets have corrected for reasons which are external to India, these have proved to be great opportunities to invest. So you can look at 1997, you can look at, 1997 was the Asian crisis, then we had the Pokhran blasts, then September 11, 2001, Lehman crisis 2008 and tapering in 2013. On I think all or most of these occasions, the markets corrected substantially. The economy was not impacted because Indian economy is not meaningfully correlated with outside Indian economy. But the stock markets are correlated over short periods of time for reasons of sentiment alone. And therefore, over time, as things stabilize outside India, markets can't fall indefinitely even outside India. So whenever they stabilize, our markets come back to their fair levels over time, and therefore you see that these falls gave you great opportunities to invest. And I see no reason why this time should be any different, because the Indian economy is, the direction is right. Inflation is down sharply, we all know that, from 11% to 10% to 4%. Interest rates are on the downward trend. And I think we should see lower rates 1 year from today. Current account is behaving very nicely. So I think last quarter's current account deficit was 0.2% with oil at $65. Now oil is much lower. So going forward, the current account should be much better, even less than 0.2% deficit. And I think the economy is in the recovery mode, though the progress in IIP, as if you look at IIP numbers, they have been a little disappointing, there is no doubt, but I still feel the direction is right and we should continue to improve every passing year.
The problem is not India, the problem is China, the world's second biggest economy, which accounts for 15% of the global output. If China collapses or contracts, I'm sure that will have impact on growth, and if growth is getting reset, that will have impact on earnings.
So I don't think China is collapsing. It is wrong to say that China is collapsing. The stock markets in China have come off very sharply. But you can't ignore what happened before the crash in stock markets in China. They went up and a lot of people, experts were saying that it's a bubble-like situation and that excess is gone now. So I would say it went up too sharply and it has come down equally sharply. But if you look at 1 year, 2 year returns in China, I think they are reasonably okay. There is nothing amiss there. And same for the Chinese economy. I think it is definitely slowing because the investment cycle in China is slowing down. But no one is saying that the economy is collapsing. It's not degrowing. It will grow maybe at 5%, maybe at 7%, maybe at 4%, but it is still growing. And I think it is, all economies, when they become large, the growth rates have to come down. And I think that is what China is going through. But I don't think this has any meaningful impact on India.
Enough and more has been debated that India has got great macros but poor micros. For the first time, India has got great top line, but earnings and bottom line is not there. Stock market investors, they always hunt for macro and micro both. So are you a bit disappointed the way our earnings are so far coming out?
See, I think yes, if you look at last 4, 5 or rather 6, 7 years, Sensex EBITDA margins have fallen from record high levels, 22 odd percent, to maybe 16 odd percent from 2008 to 2015. When your EBITDA margins fall by 6%, it will lead to very poor growth in earnings. And I think the reasons for those were very well known. But I think going forward, in my opinion, margins should start improving because commodity prices are down, and so that should have a good impact. I believe that going forward, currency should remain quite stable. Even if it has to depreciate, it should be at a very slow, modest pace. There could be even pressures of appreciation on the currency. So that negative impact of a sharply depreciating currency on margin should not be there. Wage inflation in India is down to very low levels now. It peaked at 18-20%, and now rural wage inflation is maybe 5%. The number of stalled projects is coming down steadily. It peaked at 2,500. We are down to I think 700 odd now. And as capacity utilization picks up, the operating leverages should also support improvement in margins. So I think we need to be a little more patient. We saw a similar situation almost maybe 10-12 years back, 2002-3, and when margins recovered, the profit growth was actually quite good, and I believe the same should happen this time around also. One final point is that interest rates are coming lower slowly, and that again should lead to faster profit growth.
For 4 or 5 years, markets have taken shelter in what could be called as quality companies. And let me define the definition of quality companies, which have got great capital allocation, fantastic return on capital, fantastic return on equity. Is that trade more like a popular trade now? Because if I scan through your portfolio, these typical so-called halo stocks are not there. Is that a conscious move?
I think, we were large investors into consumer staples, pharma, IT, automobiles around 2008. Because there was reasonable value in them. But today when I look at some of the multiples in these sectors, they are quite expensive. They are great companies, no doubt. There is no denying that. But I just feel that the valuations are quite rich. And I think if this economy has to improve going forward, it should be led by the investment cycle and not by the consumption cycle. Consumption in India is a secular growth story. That will continue. But whatever delta has to come in terms of acceleration in growth rates, I think should come more from the investments and less from the consumption.
Why do you think the investment cycle will pick up? Because for the investment cycle to pick up, you need fresh capital commitment. Frankly, corporate sector does not have a strong balance sheet to commit more capital. Government, yes, they can spend and they've been spending. They did a lot of spending in the first quarter of this year. That is not getting translated into the core data. Now, you've been confident that the investment cycle will pick up, but it's just getting delayed. Why is that?
See, when people say that SEBs are in trouble, or when they say corporates have leverage, these are not correct statements to make. So 5-6 SEBs out of 30 are in trouble. That's a more accurate statement. Similarly, if you look at corporates, there are some 4 or 5 groups which have excessive leverage. But it does not mean that all companies in the country have excessive leverage. Look at Coal India, look at NTPC. These are also companies which invest. Look at oil companies, look at cement companies. There are huge amounts of cash. So I think yes, there is some challenge in few groups and also in the metal space. But there are a lot of other entities, other companies which have reasonable amounts of cash. I think the challenge is that the capacity utilization in manufacturing sector is quite low. And when there is excess capacity, why should one plan new capacities? So I think industrial capex will take some time, and metals where we actually need to invest the maximum. In 3 years from today, India's steel capacity might be fully utilized if we have to grow fast, and that is where we need to invest lots and lots of money. And unfortunately, that sector is suffering from very weak profitability. So one hopes that the government will do something about it, because unless you start making reasonable money, it is very hard to invest in the same industry. But coming to the other side of it, the non-manufacturing capex, which is the infra capex, I think there we are seeing good progress. So I think roads, we all know that a lot of progress has happened. I think there should be further growth. Railways, I think a lot of steps have been taken. One is not exactly seeing it in execution, but ordering from railways has increased meaningfully even in the first half. Railways have tied up lots of funds. Similarly, I think in the transmission and distribution space for power, there is good progress. If you talk to companies, they are saying that order backlogs have grown, order pipelines are quite impressive. And finally, I think even in the mining sector, so there are very good steps that have been taken, and I feel reasonably confident that the coal production in India will grow very, very significantly in the next few years. But let us remember that capex is a long lead item. If you want to open a new mine or a new railway line, if you want to build a new railway line, it will take 1 year, 18 months of preparation. You need to acquire land, you need to do lots of things, designing, financial tie-up, feasibility studies, environment, lots of clearances, approvals are needed. I think that time is coming to an end for some of these sectors, and I feel in the next 1, 2, 3 quarters, it should actually translate into numbers also.
This government clearly inherited two problems. Number one, stalled projects, where the bottleneck is getting cleared. Second was high inflation, which magically has disappeared because of commodities, and then also a little bit of base effect has kicked in. So now that we could be staring at a regime where inflation would be low, I'm sure market dynamics and market behavior will change. So very basic question is that what will happen to market behavior in a low interest rate regime?
I think low interest rate and low inflation regime is not very good for consumer staples. And that is what we saw from late 90s till 2009.
Should it be the other way around? Low inflation means more spending with consumers?
Low inflation, first it means that the growth in consumer staples companies due to inflation or price hikes will be much lower.
Okay. Pricing power will not be there.
Pricing power is there, but the consumer incomes at some level are linked to inflation.
Of course, of course.
So how much price hikes you can take, because that supported top line growth. That tailwind is missing, and I think it is also lower inflation does not mean faster volume growth in highly penetrated categories. I mean, just because inflation is less does not mean that you or I will spend more money on soaps.
Of course.
In low penetrated categories like cars, it can make a difference because your EMIs tend to move lower as interest rates move lower. But I don't think it has any meaningful impact on consumer staples. So consumer discretionary, yes, but not consumer staples. On the other hand, as interest rates move lower, it is more supportive of capital expenditure. Because in capital intensive projects where you are levering 2 times, 3 times for one, interest cost is extremely important element. And that's how capex revives over time.
You mentioned that steel sector is a big problem for the country. Now, steel sector is also a problem for some of these corporate banks, the so-called PSU banks. Let's not use the word PSU banks, corporate banks.
Yes.
But one of your large exposure is actually some of these corporate banks. Are you not worried about what could be the impact of decline in metals in some of these corporate banks?
No, I mean, definitely there is a concern. But I believe the markets are also aware of this concern. So probably all of these concerns are discounted in the prices. And I think things will improve over the next 1-2 years. And that is how great investments are sometimes made. And that is how great opportunities are taken advantage of. I also hope that the government, or something is done to impose safeguard duties or whatever, because fact remains that India is on the verge of a massive capex cycle. Our steel consumption is extremely low. It has to go up significantly. If we have to go from 80 million tons of steel to 300 million tons of steel, you need to invest 200 million tons. And each million ton needs $1 billion capex. So, and India is the best place to make steel because we have iron ore, we have coal, we have labor, we have a local market. So, I think at some point of time, the decision makers will also see that unless you support an industry in its down cycle, the lead times to put up a steel plant are 5 years.
Yeah.
So, unless you start investing today, how are you going to meet your demand 5 years from today except by way of imports? So, I think this is simple logic what I am saying, it is not complicated at all. And I think in due course something should be done, that is what I feel.
IT is no longer the core of your portfolio. Just 1 or 2 names here or there. Is there a structural issue with the IT industry, because the IT spending, even though the world is contracting, they want to outsource more, the IT spending is actually contracting. Indian companies are growing because of market share gain, but that cannot be endless.
No, I think yes, so it is reflecting in the growth rates. If you are right that our companies have grown much faster than the market itself. So bulk of the growth has come from market share gains. and there are limits to how much you can grow by market share gains. But that is showing up in the growth rates, and it is also showing up in the multiples. See, if you go back 15 years,
Of course.
your 100% became 60, 60 became 30, and now we feel good
It's in teens now.
if the growth rates are 12-15%.
So IT is a matured sector.
I would not say it's a mature sector. I think it has good potential, long-term potential. India has a lot of competitiveness. It's a growing sector, but the growth rates will be much lower than what they were in the past.
The other moving variable is that the super cycle in commodities is over. It's unlikely to make a. There is just no case that why commodity prices would be sharply higher from here. So what happens to Indian companies? What will happen to corporate earnings?
I think the commodities part of corporate earnings have suffered already. So I think the markets have priced it in. So you look at the prices of metal companies or of oil companies, they are reflecting the current prices. So once that is in the base, it will stop impacting growth from next year onwards. So I guess we will move on from that low base.
Is the trade in OMCs, some of these oil companies over? They've appreciated.
So they have done quite well. I think there is still some reasonable value. I don't want to discuss too much specifics, but I think the big theme, we used to say that the subsidy burden will not be there on these companies indefinitely. I think that theme has played out, and it is showing up in the stock prices.
That was one of the most brilliant calls. I think this was a 3-year-old call.
Yeah, it took longer than what we had anticipated.
Yes. So just to go back to the original thesis of our interaction, you are of the view that this panic is not a real panic. When we will look back and discuss August 2015, it will just look like a blip. Long-term investors should not run away. They should in fact embrace this fall.
Absolutely. So your SIPs should be doubled. So we should invest. We should take advantage of this. Economy is improving, and there is nothing wrong with the economy. Markets have fallen because of factors which are not going to impact the economy at all. So I see no reason for any panic. In fact, we are recommending to people traveling all over the country, me and my colleagues, that take advantage of this. Buy long maturity, long duration bond funds, interest rates will fall, and buy equity funds.
What could challenge your basic thesis on interest rate?
I think, at this point of time, things appear to be, everything seems to be falling in place.
It's never been that good before.
Even if commodity prices don't fall further, that's okay. Their contribution to inflation is zero. Your current account is probably in surplus or close to nil deficit. That means currency should be reasonably stable. And if you read the G20 statement, so I thought, something remarkable was said there. The Chinese vice premier, he said that yuan should be stable for very, very long periods of time. I still don't believe that someone has put it so simply, because just 1 week back, everyone was saying that this yuan depreciation is one of the first steps, and it was not making sense. Because what does China depreciate against? They are sitting on 3 trillion reserves. They have one of the largest current account surpluses, and they have huge market share in manufactured exports. So whom do you gain against? So anyway, it's very nice that the Chinese vice premier himself has confirmed that view. So I think currency should be stable going forward, to my mind. Even if it depreciates, it is very low. MSP increases have been very low. And I think the government has said that farmers, to increase their incomes, must focus on increasing productivity and not rely entirely on MSP increases, which is a very good step. And finally, I think the investment cycle is reviving. Demand in India is not strong. So I think all the factors are supportive of lower interest rates. Something inconceivable has to happen, which I really can't think of at this stage.
And globally, as of now, it's difficult to fathom a case of a huge 2008 or a 2011 kind of a situation.
Oh, absolutely. You can't compare this with 2008 at all.
The parallels have been drawn. That's what I'm asking.
That's okay. But the circumstances are completely different. So people are saying we are speculating or discussing when will US raise rates. So no one is saying that rates will not rise. US economy is doing reasonably well. So I don't see, I mean, the US macro indicators, the fiscal deficit in US is quite low. So I don't, so there are countries, the challenged countries are those countries which were commodity exporters. So yes, there is intense pain, but these are not the large dominant economies in the world. So Middle East is in pain, LATAM is in pain, Africa is in pain, Australia could be in pain, some countries in Southeast could be in pain. But US is in good shape, Europe is in reasonable shape, China is slowing down, but I don't think there are any challenges to their stability. So I don't see any reason why we should draw any parallels with 2008 at all.
Without getting into a specific number or a return expectations, 3 years from now, if you're interacting on a same forum, what kind of market, what kind of economy, and what kind of scenario do you think we could be staring at? 3 years.
See, India is a secular growth economy,
Okay.
and we are sitting on the bottom of an investment cycle. So I think 3 years from today, our investment cycle will be a lot stronger than where we are today, and that means our GDP growth, our IIP growth should be lot better. Our how current account will behave, whether it will remain in such balance or it can go to a moderate deficit, I don't think is easy to forecast, and I don't think it is very important also. Minus 1% CAD is okay, I don't think it's a big challenge. I think the key issue will be how low can we grow with low inflation? At what stage does inflation start increasing? And that I think will depend on how commodity prices behave, number one, how the investment cycle behaves. In early 2000s, we grew at fairly rapid pace with low inflation because the investment cycle was doing extremely well. If investment cycle precedes consumption growth or demand growth in consumption.
Can it do that?
Yes, why not? Why not?
But India is always a so-called consumer economy.
Not so, consumption is growing steadily, but it does not mean that your investments can't grow faster. So we have done it in the past. If your interest rates are reasonable, if there is demand, if companies are making reasonable profits, if regulatory clearances are coming in fast, efficient way, why can't you grow? I mean, investments can grow much faster than consumption actually.
Buy fear and sell greed. Right now there is fear, it's time to put money to work. That's the bottom line.
I think so. I mean, I have always believed that fear and greed, yes, I mean it's, see, it is very hard to assess whether who is really afraid, who is really greedy, because for every trade there is a buyer.
You are greedy right now, you are a buyer.
I am a buyer, so every trade there is a buyer and there is a seller.
Yeah.
But let's focus on multiples. So markets are trading close to 14 times 1 year forward.
Yes.
So what does this tell you? In 1 year from today, it will be 12 times.
Because earnings growth.
Earnings will grow. Yeah. So what does that tell you? That your upside to downside is very favorable.
And you will grow at the rate of earnings at least.
Actually, we should make some money on multiples also.
Because expansion will happen.
Yes, because 12 Indian markets will not trade at 14 PE forever. When growth revives, when interest rates come back, when profitability is restored, I think there is room for multiples.
It's all about cycles, and the mean reversion has to happen for us to grow at higher rates.
Absolutely.
Domestic investors are really supporting this market. I'm glad that finally the SIP culture has taken up.
It is very good, and I think it is due to the collective efforts of lots of people, media, mutual funds, partners, brokers, IFAs, banks. So I think India is slowly, financial literacy is improving. So when we travel all over the country nowadays, I don't see any panic, to be honest.
So wonderful interacting with you. Thank you for your words of encouragement. Thank you for your time.
Okay.
That's it on this edition of Market Makers. It's goodbye from me. Thank you for watching the show.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.